Hello, everyone. This is John O'Legas, and you're looking at the cover of a book of mine. Uh, it's called Getting Started in Employee Stock Options. It's the only book out there that tells you how to efficiently manage your holdings of employee stock options. All right. I'm the author, along with John Suma, published by Wiley & Son, endorsed by some of the foremost options experts in the world, including Blair Hull, Michael Gray, Tim Lynn, Chris Murphy, and Tom McGurn. All right, let's get to the. All right, here is the index of the book. Shows the cover we just saw, my picture, my bio, objects of the proper management of ESOs, the risk of holding employee stock options, and other things. How to avoid premature exercises, 4 graphs on employee stock options values. All right, so let's go to the next page. Here's my picture, my phone number. That's a few years ago. All right, it shows I was born in New Orleans, went to Jesuit High School, and got a BA in math, and I was really there to play baseball. Okay, so let's get down to the reason for the tape. How to manage your employee stock options to reduce risk, enhance the value, delay and reduce taxes, and at the same time preserve the employee stockholders' alignment of interest. Okay? All right, so in the next few slides, I'll show some graphs which illustrate the fair value of the employee stock options, the change in the time premium over time, the changes in the intrinsic value, and the results upon premature exercises. All right. Here is some values of employee stock options grants based upon the Black-Scholes theoretical pricing model. If we make the assumptions that are in the box about the exercise price being 20, the stock is 20 at the grant date, we're assuming a volatility of the stock of 30%. We're assuming a 5% interest rate, although that's quite high compared to what interest rates are today. We're also assuming an expected time to expiration of these employee stock options equal to 6.5 years rather than the maximum possible expiration date of 10 years, which is generally the contractual maximum. We're also assuming a dividend of 0, and we're assuming that dividend of zero in all the graphs. All right, so we could see that the theoretical value is 82.90 under these assumptions. All right, so that's like 41% of the value of the stock, because we're talking about 1,000 options. 1,000 options gives you the right to buy 1,000 shares of stock at 20, which is a total of $20,000. And under these assumptions, the theoretical value is 8,290. Now, if we would have assumed a substantially lower volatility, a substantially lower interest rate, and lower time to expiration, that theoretical value could be quite a bit less. On the other hand, if the volatility is higher, the interest rates are higher, or the time remaining is higher, the the theoretical value could be quite a bit more. All right. Now, let's suppose the stock goes from 20 to 40 in a few years. Well, the theoretical value of 1,000 options to buy the stock at 20 when the stock's trading at 40 consists of two parts. One is the intrinsic value, and another is the time value above the intrinsic value. And so you can see here the total value would be $24,526, 20 of which is the intrinsic value. All right, and you can see how what the theoretical value is if the stock goes down. It decreases quite a bit, and it's all time value, just like the value at grant date is all time value when the exercise price is equal to the market price on the grant date. All right, let's go to the next graph. All right, so here we're looking at the same graph, except I've separated the time premium or the time value, which is exactly the same thing, from the intrinsic value. See, the intrinsic value is exactly the difference between the exercise price and the stock price multiplied by the number of shares that you own. So if the exercise price is 30 and the stock's trading at 40, well, if the exercise price is 20 and the stock's trading at 40, the intrinsic value is $20,000 for 1,000 options. But there's still some time premium or time value left. And as you can see, under those circumstances we just talked about, with 4.5 years expected time to expiration, with a 30 volatility and a 5% interest rate, the time value, which would be forfeit if you exercise, is $4,524. So that's a penalty of making an early exercise. And there's also another penalty, and that is the paying of the early tax. All right, let's go to the next graph. All right, so here what we've done is we've separated the intrinsic value from the time premium as we did in the earlier graph. But here we're taking the tax, or the expected tax, that may be due upon exercise. We're assuming 40% here. All right, so if the stock is 50 and you have an exercise price of 20, the intrinsic value is 30,000, but you may have to pay 12,000 of that 30,000 in taxes. And in California, you actually have to pay more. You'd have to pay 14,000 if you're in a high tax bracket. Okay, so this gives you an idea of what happens when you exercise. You forfeit that time value. You pay the early tax, and you have the net proceeds after exercise and sale, after paying the exercise price and paying the taxes. You have what's in the green. All right? Net to you. Now, let's see. If we're assuming now a higher volatility, that will change the time premium or the time value. All right? So the following slide changes certain assumptions that were made in the previous 3 slides, although the exercise price and the dividends stay the same. The main change is the volatility, which goes from 30 to 60 and overwhelms the assumptions of the lower interest rate and less expected time to expiration, those two which would lower the time value of the options. But the change from a 30 to a 60 volatility raises the time value, which offsets these other factors that lower the time value. So we can easily see the differences in the time premiums when there's a higher volatility. So let's look at that. All right, so you see here, these time values are much greater than they were in the earlier graphs. For example, in the earlier graph, we saw that the time value when the stock was granted with a strike price of 20, and the stock was trading at 20, and there's 6.3 years or 6.5 years, we saw that the time value in the earlier grant with the low volatility of 30 was equal to 82.90, which is 41% of the value of the underlying stock, which is $20,000. But here, with these assumptions about higher volatility, you can see that the time value is quite a bit more at the day of grant and all the other days too. Okay, so what happens is when you have a higher volatility and you make an early exercise, you forfeit the remaining time value back to the company essentially. And the intrinsic values and the taxes remain the same regardless of what the assumptions are about volatility or interest rate or time remaining. Okay, the change of assumptions changes the time value. It doesn't change. Of course, if we assume the stock is higher, of course, that's going to change the intrinsic value. All right, or if we assume that the exercise price is lower or different, that's going to change the intrinsic value. All right, but the other assumptions about volatility, interest rate, expected time to expiration only go, and the dividend only goes to change the time value. All right? So now let's think about the risk of holding these employee stock options. Now we can visit the link below for an idea of the risk associated with holding these employee stock options. I'm not going to go into that, but I'm just saying that if you go to that site, www.holdly.net, you can see how risky holding your employee stock options is. And it's quite risky. So, for example, on the day of the grant, the probability of losing 100% of the option's value is about 30 to 60% if held unhedged to expiration, and the 30 to 60% depends upon the volatility of the stock. The higher volatile stocks have a greater chance of being worthless at expiration. All right? So what you want to do is you want to try to avoid premature exercises. And the reason is because the premature exercises forfeit the remaining time premium or time value, which is the same thing, back to the company. All right. If there isn't much time left and the stock is way in the money, the time value won't be much. So if you exercise then, even though you may have a couple of years to go, it's not that big a penalty, but it is some. Okay, that's why you see the top executives of large companies who can afford to and get the best advice, or at least good advice. They're holding their employee stock options to near expiration date. And that's what you should do as a employee, whether you're an executive or a manager or just a truck driver. All right? You should try to hold them to expiration. However, there is risk associated with doing that. All right? And there's a way of actually holding them to expiration and reducing that risk if you're willing to go sell calls or buy puts. Now, these top executives seldom do that because there's people that watch what they're doing, and if you're watching CEOs of major corporations selling calls, that might be an indication to you as a holder of small amounts of employee stock options to do the same. All right? And they don't want you to do that. But nevertheless, try not to make early exercises because it forfeits the remaining time value back to the company and causes an early compensation income tax on the intrinsic value of the employee stock options when you exercise. And the tax has to be withheld when you make the exercise or shortly afterwards, depending on certain subtle tax laws like IRC 83C3. All right, so if you want to reduce the risk and you at the same time want to hold these things to near expiration or hold them as long as you can, what can you do? You can hedge your employee stock options by selling listed calls in the exchange traded market. And we suggest that you sell the ones that are slightly out of the money and the longest calls that are trading on your particular stock. So we want to sell the slightly out of the monies, the longer the trading, the better. Okay? And we also might buy some puts at or in the money. The longer ones are better. Of course, the longer ones often have wider bids and offers, and sometimes you might go with one that has a year to go or 18 months rather than 2 years or 3 years. Okay? It all depends on a number of factors. But perform this strategy by creating small positions in the early years after the grant, even when they're unvested. If you want to reduce your risk somewhat, okay? And this selling calls prior to vesting is not available to the Section 16 executives. And I'll get into that another day as to why. All right, the next graph is the most important graph of this slide presentation. And it shows 3 graphs which compare the results of selling 30 listed calls with a strike price of 450 versus holding, or while you're holding these employee stock options to buy 3,000 shares of Google stock at 350 with the stock trading at 416. Okay? And we're comparing the results of selling the calls against while holding these employee stock options. And we're comparing those results to the results of holding the employee stock options to expiration unhedged. All right? So this subsequent graph is going to compare the results of just holding them to the end, and that's comparing that result to selling calls. Okay? Now, we're here assuming that the employee stock options have a exercise price of $350 and the stock is trading at 416, and the exercise price of the calls that we're selling is 450, which is slightly out of the money. All right, so we have some employee stock options which are substantially in the money, and you have 3,000 of them. So we're selling some calls that are slightly out of the money because the stock's trading at 416. All right, now the graphs have vertical axes which show the value of the combined positions at expiration. The blue graph shows the results of holding the employee stock options unhedged to expiration, which equals the intrinsic value at expiration. The green graph shows the results at expiration of hedging by selling 30 calls for $8,300 each with a strike price of $450. Both the employee stock options and the calls expire in 20 months after the sale. The red graph shows the results of selling the same 30 calls versus employee stock options to buy 3,000 shares. But here, the employee stock options expire 2 years after the calls expire. And so the difference between the red graph and the green graph represents the remaining time premium or time value, which is the same, in the employee stock options with 2 years to expiration. Although the graphs assume a sale of 30 calls versus 3,000 employee stock options, we seldom advise hedging beyond selling 60 or 70%, which in this case would be maybe 2,000, okay, or 1,700 or something like that. But here, just to demonstrate it in a simple way, we're assuming you sold 30 calls. All right? So here's the graph. On the bottom, the horizontal axis shows the stock price at expiration. The vertical axis shows the total results that occur with the various strategies. The blue graph illustrates just hold to the end with no hedging or no premature selling. Hold to the end with an exercise price of $350. If the stock's below that, you get zero. If the stock's above that, $350, you'll get some money. If the stock is trading at $450 and you have the right to buy 3,000 shares at $350, each one of those options are worth $100 each, and therefore your 3,000 employee stock options are worth $300,000. If the stock is $550, the employee stock options are worth $600,000. All right, and if the stock is $650, the employee stock options are worth $900,000. That is 3,000 of them. So you see, your value or your gain is unlimited on the upside if you just hold the options straight out to expiration. I mean, if the stock is 1,000, then your options are going to be worth $3 million. All right. Now, that's not impossible by any means, because we're talking about 2 years or 4 years to expiration. All right. Now, let's look at the green graph. The green graph shows when you hold these 3,000 employee stock options and you sell some calls which have 20 months to expiration, and you get $8,300 for them. You're selling 30 of them. They have an exercise price of $450. All right. So those calls, if you sell them and hold that short sale or that writing position, or some people call it, and it could be called covered rights. If you made the covered right of 30 calls and got $8,300 each, what you're doing is going to make a profit on those calls if the stock is below 450 at expiration, regardless of how low the stock is. If the stock goes up substantially, those options that you sold could be quite valuable, and it essentially eliminates the profit on the extreme profit on the upside. Okay, because that is in the combination of the two trades or the two positions. All right, so if you sold the 30 calls and got $8,300 each, that's almost $249,000, which you will get if the stock is 350 or below, because at 350 or below, your employee stock options are worth zero. So you get nothing for those, but you'd still make the money on the calls that you sold. Of course, now let's suppose the stock goes to 450 and we're looking at the green graph now. What is the result? The result is your employee stock options are worth $300,000, and you're going to make another $249,000 on your sale of the calls, which expire worthless. All right? So if indeed the stock goes up higher than that at expiration, the amount that you'll lose on the calls will equal the amount that you gain on the employee stock options. And so that's why the green graph becomes parallel as you move to the right, because you don't get that profit increase because you'll be losing as much on the short position of the calls as you're gaining on the 3,000 employee stock options. All right. So as you can see, no matter how far you extend the stock price on the upside, your total value at expiration of the employee stock options plus the sale of the calls remains the same after you get above 450. Now, the other graph, the red graph, shows when your employee stock options have another 2 years to go to expiration beyond the expiration of the calls that you sold, which had 20 months to expiration at the time of you selling them. Okay, so there is some additional value above the intrinsic value when the calls that you sold expire. And that difference between the red value on the horizontal or on the vertical axis and the green value on the horizontal or on the vertical axis, the difference between the red graph and the green graph is the remaining time value in the options that have 2 years to go. Okay, and as you can see, that difference gets smaller as you get the stock going higher. All right, so this is a very interesting graph, and if you analyze it, you'll say to yourself, well, which would I rather have? Would I rather have the blue graphs or the green graph or the red graph? All right. So if you are not risk averse and you think that stock's going to go way up, then you're probably better off with the blue graph. The other two graphs limit your upside. Okay. In retrospect, when Google went as high as it did, you would have been better off uh, sticking with the unhedged position. But of course, if the stock would have been below 350 at expiration, you'd get nothing. All right. Whereas the other graphs give you profit. Okay, let's go on. See what else is here. All right, now what's the tax treatment on hedging those employee stock options? Is it friendly? Well, it gets a little complicated, but IRS Section 1092 should not apply to hedging employee stock options in my view, but the IRS says it does. So you have to accept that and assume that when you sell those calls against your employee stock options, you are creating a straddle, a quote straddle, which is subject to IRS Section 1092. The construction sale IRS section is not an issue. The only time that would be an issue if you sell calls that are substantially in the money and will move around almost like the stock itself. The wash sale rule under Section 1092 is not a constraint. There are some loss harvesting opportunities. Okay, I'm not going to get into that too much. In our view, the concern for the mismatching of tax treatments, where the possible capital loss on the sale of the calls are matched versus the ordinary profits on the ESOs, is overstated. Although it has to be kept in mind, and that's partly the reason why we say don't sell more than maybe 70%, whereas those graphs assume that you sold 100% of calls matched off against 100% of the employee stock options. All right, so if you sell less than 1-to-1 and you get a big move on the upside, you do have an increased amount of gain even though you sold the calls as the stock moves up higher. All right. One thing that is to be done is that when you sell these calls or buy these puts, you should declare the offsetting positions as identified straddles. And that has some good consequences, which I won't get into now. Other restraints do not preclude effective hedging. Generally, the company's documents do not prohibit hedging, but generally the company's plans do not allow transferability, and most stock plans do not allow pledging the employee stock options to make a loan. Margin rules are reasonable because you're going to be subject to the margin rules if you go sell calls. The SEC rules and securities laws are reasonable. Tax rules are friendly. Alignment of interest continues longer with hedging because after you hedge, you still have a positive long position. You still have an alignment with the company. Whereas exercise pays a tax, forfeits a time value, eliminates the alignment. Now there's some new developments which may be interesting. There's been some pledgeable employee stock options for margin purposes created. You have changing implied volatilities of stocks over time, which change the values of your employee stock options. The value will be changed the most if the stock is not too far away from the exercise price. All right? So when should you sell calls? When should you buy puts? Well, my view is that you should start small in the early years and see what happens and whether you like it. And then over time, sell and create larger positions, because over time you probably vested and the stock may have gone up and you have more risks that you want to reduce. You can use your IRA to perhaps buy puts. And there's an interesting tax trick that comes with buying puts in an IRA. Now, there's also one other concept that I want to mention here, is that when you're looking at the strategies of what you should do and comparing them, you should consider the after-tax equivalent stock position, or the equivalent stock position gains after tax. And I'm referring to it here as after-tax delta. Delta means the expected amount that the option is expected to move with a short term movement in the stock. All right? So with all of this in mind, I'm going to terminate this discussion, and I say take a look at my book if you want to, or give me a call if you want to talk more about this. 504-875-4825. Thank you for listening.